Hello and welcome to the BC Pension Corporation information session. Thank you for joining us. We're here today to answer your most asked questions about your pension. Now, this session is being recorded as the live event originally scheduled for October 16th, which was canceled due to the ongoing BCGEU labor dispute. We appreciate your understanding and patience during this time. And when you registered for the live session, we invited you to submit your questions in advance, and we received a strong response. Thank you. And your questions have helped shape today's content. We'll be addressing the most commonly asked questions throughout the presentation. My name is Vanessa Lamont, and I'm the Digital Community Manager at BC Pension. And we're very lucky that the expert joining us today to answer your questions is Anna Peakman. Anna, I hand it over to you to introduce yourself.
All right. Well, I have the pleasure of being here today where I'm normally spending my time as Assistant Director in the Operational Compliance, Risk, and Actuarial Services branch. But I recently arrived here. Where I've come from is over 30 years in the plan operations area, leading the teams that actually perform the day-to-day functions to serve you, our members.
All right, let's get into it. The very first question is, and I'm sure it's no surprise, is when can I retire? A common question, I'm sure.
It is a common question, but you might want to reframe this as when can I start planning to retire? And the simple answer is it's never too early. So to help you understand some of the thresholds, I want to draw your attention to a product that we send out every year called your annual members benefit statement. And what that does, it provides you a snapshot of the progress that you've made in your contributions to the pension plan. Think of your contributions as a love letter to your future self. And I'm going to familiarize you with some of the language you'll see on that statement that talks about the different thresholds. Now, we all talk about early retirement. And to understand that, we do have to understand that we do have a couple of different segments in the municipal pension plan, where most of you belong to the general or group 1. And that has the earliest retirement age of 55. We also have a segment under the public safety employments for firefighters and police officers, and understandably, they have a slightly earlier retirement age threshold of 50. Now, they often refer to this as the earliest unreduced age. And then another threshold is that you'll find along the way is the earliest unreduced, where your age and service totals may have gone beyond a threshold where you have a slight reduction applied to your pension plan. And then finally, we have the latest retirement age, which is driven by the federal government requirement currently set at age 71, where your pension must be put into pay by the end of calendar December 1st of the year that you turn age 71. So those different thresholds along the way, so 55 is the earliest you can go, and then these other threshold markers between the ages of 55 and 65 will determine, based on your age and accumulated service, how quickly you can retire. But you got to start thinking about, what do I want to do in retirement? Because an age is one factor, but it's also driven by what kind of lifestyle you want to have when you retire.
That's great. So you mentioned the member benefit statement. Another great resource is the plan website. And so if you want to begin your retirement planning, go to the website and try searching when can I retire, and then start with what some of those first results as a way to get started. And then obviously with the question of when can I retire, the other big question is, how is my pension calculated?
You know, it's interesting. I think we have to start with the basics, though, to understand. You're really fortunate to be contributing to what's called a defined benefit plan. And what sets it apart a little bit differently, most of us are familiar with things like RSPs or defined contribution plans, where the money that you put into it and the money that it earns over time as an investment drives what your eventual benefit will be. But they're great plans. But what makes the defined benefit plan even a little bit more beneficial is that it uses a formula to calculate your ultimate benefit. So it affords you a degree of predictability or forecasting, which is why planning sooner than later is always so integral. And these defined benefit formulas have a goal of providing you with a lifetime payable benefit. So the pension that you will eventually accumulate is payable for as long as you live. That's an incredible type of benefit. So before we get into some of the details, I do want to emphasize that this type of format's challenging to start talking about the mathematic equations. And as you mentioned, there's some amazing resources on the web. And it's as simple as typing in the search bar, how do you calculate my pension? Because there's also some changes that have occurred in the last few years with the development with your plan partners, the BC government, the Union of BC Municipalities, Municipal Pension Committee, and ultimately approved by the Municipal Board of Trustees to modernize some of the structure of your pension plan. So just to walk you through a simple example that covers probably the vast majority of you listening today, I mentioned a formula. So it's a two-tiered accrual rate for all of your service up until these plan design changes that took effect January 1st, 2022. So an example is your formula comprised of one is a percentage, the other is the total pensionable service that you've accumulated, and you accumulate that by virtue of going to work and making contributions against the salary that you're earning. And then we have this language around your highest average salary, which is determined for the group one folks over their best 5-year average, the best 5 years of earnings they've had in their career. For most of us, it tends to be the last years of their working life. And then any applicable reductions that may apply depending on how much time you've accumulated so far. So a simple example, the other thing that we need to familiarize you with is a language called the YMPE, the year's maximum pensionable earnings. And that's what makes up that two-tier portion of the formula for all the service you've accumulated up to the December 31st to 2021. So the formula works, it's 1.3% times the YMPE, the year's maximum pensionable earnings, which is the threshold that you're making Canada Pension Plan contributions to. And then if your salary is beyond that, we apply 2% times the salary that is above the YMPE times your totality of service, and again, any type of early reduction factor. Then we also have a portion called the bridge benefit, which is currently in the service up to December 31st, 2021, 0.7% times the YMPE. And that offsets a little bit of your lifetime pension. Then the other beautiful facet of this pension plan is it has the ability to provide cost of living increases. So once your pension is put into pay on an annual basis, there'll be, if there's funding available, there'll be a potential cost of living increase. And once those cost of living increases are added to your pension, they form part of your permanent benefit.
Wow. I'm glad we have experts to help us figure out all of these details and these great resources. So you mentioned to search for how is my pension calculated on the website. And there's also excellent videos that really help explain some of those plan changes. Some of them are a bit longer because obviously it's a complex topic, but the great thing is they're also closed captioning for any of us who prefer closed captioning or who are hard of hearing. So again, great resources to help have these sort of harder, more complex conversations and grow the understanding. And so you mentioned the bridge benefit. How does that work for people who retire before the age of 65?
Yeah, one of those things that to understand it is probably a little important to have a little bit of a history lesson. So it might surprise a lot of you to know that the Municipal Pension Plan has been around since 1939. Wow. It's coming up on almost 100-year anniversary. And so the defined benefit plans in place at that time carried on, did their thing. But lo and behold, in 1966, the Canada Pension Plan came in as a federal program that was mandatory retirement program for all Canadians. And most, if not all, the defined benefit plans in place at that time recognized that this additional pension contribution could put a little bit of pressure on their folks. So that's where they incorporated the two-tier program of their pension formula. So as I mentioned with the group one, where you have the 1.93% and then the 0.07% of the bridge, That at the time reflected relatively closely to how much Canada Pension was going to pay you. And if you retire before the age of 65, that bridge portion of your pension is paid back to you until you reach age 65 or pass away, whichever comes first. And as I mentioned, if there are any cost of living increases added to your bridge and the lifetime portion of your pension, they would stay in play. But when you reach age 65 or pass away, the bridge and the accumulated COLA or cost of living attached to that bridge would cease to be paid. Now, over the course of years, we've seen some modernization happening with Canada Pension, where they allowed you to start drawing it early at age 60 with a heavier reduction. But the defined benefit plans are continuing of their own modernization, and that is indicative, as I mentioned, in that formula change that came into play January 1, 2022, where there's actually no element of bridge going forward for the service that you're earning beyond that date. And Vanessa, I really appreciate you bringing those videos up because they're a beautiful combination of the illustration of the formulas and the narrative to help drive that home understanding of how those things work. But eventually, there'll be a point where people my age going forward, 30 some odd years from now, they won't have a bridge portion of their pension.
Because everything's sort of modernized along the way.
Correct.
And with all of these options, like how does someone choose the right option for themselves?
This is one of the things when it comes to the pension options, there are a host of different options that are presented. So when you sign into my account, for example, and you perform a pension estimate, we're going to show you basically the series of options that suit most people's needs, although there's some fine tuning that you can do. But think about this way. The options are a way for you to determine the legacy of what happens to your pension if you happen not to be here to collect it. You really simplify my life if you decide to live forever because I'll continue to pay you. But unfortunately, being that we do have the human condition, at some point we will be passing away, and we need to ask ourselves, who is dependent on the income if I'm not here to collect it? And what are my overall goals in retirement? How is my overall health looking in retirement? So there are a variety of options that play a role. So once we've calculated your pension and we end up with the end result, this is your monthly pension, then we convert it. And the first series of options are called single life. And as the name implies, they consider the age and mortality possibility of the member themselves. And so you can extend a guarantee against your pension for 5, 10, or 15 years. And what that means is if you chose a single life 5-year guarantee, your pension purchases that option. It costs a little bit of money. But you're saying that my pension is going to be paid to myself, or in the event that I passed away in year 4, my beneficiary or my estate will receive the benefit of the final payment up to the 5th year guarantee. You can name a beneficiary, or you can name your estate. Estates, however, they're not allowed to receive perpetual payments because as you can imagine, you can't keep an estate account open for 15 years potentially. So, if the estate is the beneficiary, will roll the guarantee up into a lump sum payment. So that's just based on your lifetime. But if you have a spouse, this is when things can get a little bit more interesting, in that a spouse that meets our definition, which is a fairly broad definition, so odds are pretty good if you think you have a spouse, you probably do.
Good to check.
It's good to confirm. But a spouse is entitled to protections under the pension plan unless they make a conscious decision to waive them. So the pension plan says, pension legislation dictates that you must protect at least 60% of your lifetime pension into a joint life and last survivor option, unless your spouse is willing to waive that entitlement or the right to that. And to do that, they actually have to sign a specific form that says, I don't need it. So the other option is 100%. Well, 100% joint life and last survivor considers not only the age of the member, but the age of the spouse. And the intent of that option is to ensure that whomever survives the longest will receive the payment in full. So 100% joint life means you retire, If 15 years later or 20 years later you pass away and your spouse is still living, they'll receive those funds for as long as they live. It's the only permission of this type of option is to be with a spouse. As you can appreciate, if you try to nominate a child, the cost to guarantee that child's lifetime would be very prohibitive to your monthly pension. So it is restricted to spouses only. And then if you choose anything less than 100%, that is combined within a 5, 10, or 15-year guarantee period. So for example, you can say, my spouse has their own pension. They don't need the 100%, but I want to reduce that to the 60, and I'll attach a 5, 10, or 15-year guarantee as well, which is great. I can hear a lot of people asking in the room, that's all well and good if I live to retirement, but what happens if I don't? And that is a reality, unfortunately, for some. And there are pre-retirement death benefits that are driven by how old you are at the time you passed away, how much service you have, and whether or not you have a spouse. And those include a spouse is provided an option for a monthly pension or a lump sum benefit. But the retirement options are where you get to determine the legacy. So it's important to factor in all of the needs that you want to have for your family members.
That's great. There's certainly so many options to consider and conversations to be had. And with that in mind, again, the plan website has incredible resources. If this is something that you're considering in terms of wondering what the plan options are, please search, choose pension option or pension options and look at some of those incredible resources.
I do want to circle back on something around some of the options that have been modernized over time. So we talked about how the bridge is slowly phasing out of the plan, but another vehicle that you can draw money out of the plan before the age of 65 to front load your pension is by purchasing a temporary annuity. And as part of the modernization, now you're able to buy a portion of the temporary annuity, half or full. But it's a great way if you're looking at trying to accumulate more out of the pension a little bit faster. Maybe you're looking to pay off an asset, or you're looking to do a little bit more travel or something in those first years in retirement that are often referred to as the go-go years. But that's just something else that helps improve the types of options that make the best choice for you and works for your family.
That's great. I'm glad you mentioned about purchasing because we actually have a few questions about buying service. So the first top question that came in is, can I buy service for the years that I worked for my employer before I joined the plan?
Yeah, and I think this is a great question because it's very, very common for folks when they first start working with an organization that they might serve some type of probationary period.
Mm.
And during probations, you're not typically permitted to contribute to the pension plan. So you can apply through your employer to buy that time and have that time recognized. And the quick answer is anytime you buy pensionable service in the pension plan, you're improving that portion of the formula. So it is going to improve your monthly pension. What makes that decision on whether or not to buy it uniquely yours is it depends on how long it might take you to recover your investment, that purchase. And when it comes to that, it's all very personal. So if someone were to say to me, if I bought my non-contributory period of service, maybe it was 3 months, and it's going to take me 5 years into retirement to recoup the investment that I'm making. One person might say, that's a great deal. Another person might say, I'm not so sure about that. So, and given that you can buy service with cash or transfer from existing RSPs, it's a good idea to consult with potentially your very trusted financial advisor to see how that factors in with all of your other retirement income sources or investments to see whether or not that's the right path. And I would also mention there are different purchase types that are associated with different types of life events. So we covered off one, but another one that's really common, maternity or parental leave. There are lots of different leave types available or leaves that might cause a disruption in your accumulation of pensionable service that are in fact recoverable. But one thing that is common for all of these is you have to apply to them and you have to do it by a deadline.
Oh,
So it is important to ensure that you don't sacrifice the option to do this. And so reach out to your employer when you get back from your leave or your absence, or you've started your contributions after probation, and make sure that they get those applications to us right away. We'll do the calculation, and when we provide you with your cost invoice, you'll have 90 days to think it over. You'll have a cooling off period to think about it and make those consultations. And and then in that information, you'll also be told how many months on pension or how it's going to increase your pension overall. And you can make that decision about whether or not you think that recoup of investment is worth it in that time frame.
that's great. So if you think that might apply to you, again, do you go to the plan website and search for buying service, or if you think it might be buy non-contributory service, those are both great places to start. In addition to just the great overall resources, there's also really fantastic articles that really sort of set up the different scenarios that might apply to you and what some of those benefits might be. So a great place to start. And I think, as you might, overall, there's so many great pieces of information. And we've been trying to sort of share some great search links for you. A big question really is what other resources are available to help people plan for their retirement?
Well, the beauty of this is it's getting broader and bigger all the time. But I can't emphasize enough the website, which I find super easy. Just asking a simple question in that search bar can get you so many links to so many things that you can explore. I also mentioned the My Account with self-service options as an active member, and we also have the service that extends into retirement, which is another great way that you can access things like your personal pension estimator. You can go in there and play around with, different ideas. Okay, so I can project that if I stay in the same job for the next 25 years, or maybe I'm actually going to extend myself and apply for that other position. How is that going to change my pension trajectory? So there's a lot of that. But it's also important to explore that the municipal pension plan is one facet of your retirement income potential. We also, as you have mentioned a couple of times, there are the federal programs, Canada Pension, Old Age Security. I've been exploring myself. Obviously, I'm getting a little bit closer to that potential threshold, and through the advice of my own financial advisor, they put me on to some fantastic YouTube videos on those federal programs. Some are a little bit more easier digesting than others, but certainly there's a lot of that. There are also online courses, and there's also webinars that we offer. And I don't want to undervalue as well our member contact center. When they are available, they are a plethora of people that are ready and willing to answer your general questions or more specific questions or help you find some of these great self-service options.
That's great. And it sounds like it's never too early to start planning.
Never too early to start. Again, as I said, and I'll reiterate this, when I first started doing pension calculations, I started having visions in my head of when I might retire. But it really is a love letter to your future self.
I love that. Well, thank you so much, Anna. And thank you to those who are watching and for everyone who submitted their top questions. As we've mentioned, there are fantastic resources available to you to help inform your pensions and your pension decisions. So please spend some time checking that out. And you can also refer to your member benefit statement as you mentioned earlier as well. So thank you very much for joining us and have a great day.